Australian dollar fell to one-month lows this week as markets prepared for the Federal Reserve to raise interest rates on the 15th of March. The Australian dollar was actually in good shape in the first half of the week, supported by a stronger than expected GDP report. The Australian economy grew 1.1% in the fourth quarter, a sharp rebound from the 0.5% contraction in the third quarter. In the details, there was a pleasant surprise as business investment posted a small gain, snapping a sequence of several years of decline as the mining boom investment unwound. But the biggest upside surprise was on household consumption, which jumped 0.9%, about double the previous quarter. This is particularly surprising given that overall wages and salaries actually fell 0.5% in the quarter. In particular, what seems to be going on there is the switch from full-time to part-time work. This meant that the household savings rate fell sharply to its lowest ratio since just before the global financial crisis in 2008. So there are some areas of concern in the report, but overall the RBA's 3% growth forecast for the end of the year looks to be on track with year-over-year growth in the report at 2.4%. But after finding some support from the GDP data on Wednesday, Thursday was a tough day at the office for the Aussie dollar. The January trade surplus was expected to be another record. Instead, it fell $2 billion on the month to just $1.3 billion. Imports bounced in the month, but the main surprise was that exports were reported as having fallen sharply. Part of this was a steep decline in gold, with gold export revenue falling almost $800 million. That's very volatile month to month and difficult to predict. But we were really surprised that the ABS reported that coal and iron ore export receipts also fell. With Australia's key commodity prices still quite high, we expect that the trade surplus will recover in the February data. But for the time being, it was a definite setback for the Aussie. But the Aussie's biggest move on the week was a 1 cent fall to around 75.60 as markets scrambled to price in a Fed rate hike on the 15th of March. The probability of the Fed raising the funds rate to a 0.75 to 1% target range is now up to 75%. This move was driven not so much by any US economic data, but by Fed commentary. In particular, New York Fed President Bill Dudley said that the case for a rate hike in March was now a lot more compelling, while Governor Brainard said that it was appropriate to raise rates soon. These Fed comments turned out to be the key driver of markets this week, rather than President Trump's address to Congress. In it, he detailed lots of fiscal spending plans, but no clear indication to markets of where the real priorities would be to pay for these. In Australia's week ahead, the main focus will be on January retail sales data and also the RBA meeting on Tuesday. The RBA is sure to hold the cash rate at 1.5%, and its statement is likely to remain quite positive on the economic outlook. Internationally, the key events include China's National People's Congress, the European Central Bank policy meeting, where policy looks to be firmly on hold, and the US February employment report. While, of course, markets are always very focused on the employment report, and it is the final one before the March decision, we doubt that the Fed will change its view based on that number. We think the Fed looks pretty confident in its outlook for the US economy. With that in mind, the US dollar is likely to remain quite strong. That should see the Aussie dollar capped on rallies to about 76.50, with the risks to the downside back towards about 75 cents. We'll speak to you next week.